To give us their views on the banking sector, Hemindra Hazari of Nirmal Institutional Equities and Vaibhav Agrawal of Angel Broking with us. Hemindra, first up, let's discuss the positives. Would you see banks begin to report treasury gains? If I look back at the September 30 bond yield, I think it was 8.44 on the 10-year. So if it comes there, or even if it doesn't come there, if there are quarterly buys and sells, do you think we could see treasury gains in some bank stocks?
In my view, it's highly unlikely, because I think we shall see treasury gains in bank stocks when the yields go below 8.25. Till then, they only have some incremental gains on the bonds which they had purchased when the yields were very high. But on the overall portfolio, in my view, it is underwater currently, and only if yields go below 8.25 will you see gains on the bank's bond portfolio.
Your take, Vaibhav, is there any small positive at all that will emerge because of bond prices? At the moment, 8.5 could be cut if and only if there's perhaps a CRR cut.
Well, at least, first of all, the fact that it has come down from almost about 8.8, 8.9 levels, earlier during the quarter, at least averts MTM losses to an extent for the banks. And secondly, what we have observed even in the past quarter is that when there is a lot of intra-quarter volatility in the bond yields, there are going to be some number of banks which will report, trading gains on account of smart trading, and while at the same time there will be a few who will end up being losers. So, it is really not worthwhile trying to quantify this. There would be a small amount of gains coming in for some of the banks, while some others could see some losses as well. But broadly, at least, large MTM losses have clearly been averted.
Hemindra, hi, thanks for joining in. Wanted to understand basically what your view would be on asset quality at this point in time for banks, and which sectors do you see most pressure coming in from?
See, asset quality to me is the key concern for banks, not so much MTM losses, even if say yields were to go up from these levels, because at least we're dealing with Indian sovereign paper, which is unlike Greek or Italian sovereign paper today, where there's no loss on principal. But regarding asset quality, I think that is a very major concern. We expect to have going forward a more prolonged economic slowdown, because you're clearly seeing total inaction by the government. Therefore, you should see asset quality deteriorating in the SME sector firstly, which you're already seeing that. This will be followed by the infrastructure sector, where there has been very large loan growth taking place. Now here I believe the RBI would step in to have some very major restructuring proposals put forth. This, in my view, would only give temporary relief, because in the long term these projects actually have to move on the ground, and that is what is stopping them. So unless the government does not do anything, which appears to be the present disposition, we're looking at some serious problems ahead.
Well, the reason why I'm relating asset quality fall, which is clearly the big theme in the banking sector, and the fall in yields is, if you recall in the 2003, 2001-2004 period, when yields were falling like 9 pence, and we saw yields, the repo rate itself fall perhaps from 9% in the late 90s to maybe 4.75. A sizable amount of gains were made, and those were adequate to, not adequate, those to some extent helped banks face their asset quality losses, which coincide in the same period. Almost always when yields are falling, you find asset quality also a problem. So as we look into the future, into the rest of 2012, and factor in repo cuts and maybe CRR cuts, maybe a repo rate of 6.5 or 6.75, do you think some of the asset quality losses can be mitigated by MTM gains? Hemindra.
Yes, I think we have to also look back in that period. That period you were seeing, higher GDP growth also, that was the direction. Currently, you have to combine your view on interest rates with the outlook also on growth rates and what's happening on the ground. Unfortunately, on the ground, it depends what view one has, and we are holding a view that the economy will slow down, because we do not see any major FDI coming in, nor do we see the private corporate sector really investing in capex. Now, if the lower interest interest yields were to come in place simultaneously with the growth prospects improving, I would hold and take your view. But unfortunately, at this moment, I do not take that view of higher GDP growth coming in, and I do not expect that lower interest rates, even if they were to come about, would be the main driver for a higher GDP growth rate going forward.
Vaibhav, just want to come to you with regards to this entire discussion on asset quality in specific. Which which banks do you think would possibly be the most insulated or the most protected in having the least amount of asset quality concerns, and what would your recommendation be on those?
Very clearly, for a large majority of the PSU banks, we do see asset quality concerns increasing going into the next few quarters. So for a large majority of these banks, we actually have a cautious or a neutral view. However, there are a few pockets of banks where we do believe they've been conservative over the last couple of years, where we believe the deterioration would be relatively lower, and the risk to book value is definitely not there, while many of them are trading well below book value. So there are a few selective stock picks that we have. For instance, definitely as far as in the private space, the large private banks continue to look quite healthy, and they've created a lot of buffer in the balance sheet as well. Secondly, coming to the PSU space, on the larger ones, we like Bank of Baroda right now. We do believe that the earnings performance of the bank has been driven more by operating efficiencies rather than risk taking. And also coming down to the smaller banks, there are a few such as Syndicate Bank and Bank of Maharashtra, which have been quite conservative in the last 2 years, and they're trading at 0.6, 0.65 price to book, and we believe the deterioration is likely to be much lower in these compared to the rest of the space. So these are a few of the banks that we like on account of their more conservative asset quality profile.
Similar question to you, Hemindra. A lot of the banks have provided adequately for a lot of their bad assets, and we saw some kind of plateauing of bad assets for even big banks like Bank of Baroda and PNB to some extent. What would be your picks at all, perhaps stocks which may relatively outperform in a falling market?
See, I am negative on the banking space, therefore I would really have sales on all the large banks in this country, including the private sector banks. I would rather be more cautious, and the only bank where I'm positive on is Syndicate Bank, because I believe this bank has been conservative in its asset growth in the last 2 to 3 years, particularly in the infrastructure space, and therefore I'm confident about the quality and the extent of earnings growth going forward. So with the exception of Syndicate Bank, really I'm not at all positive on the other banks.
None at all in the private sector?
At best, I may be positive on HDFC Bank, but I think one has to understand and appreciate that a lot of the new private bank balance sheets now as big as some of the PSU banks, and they cannot be immune really to a broad economic slowdown.
All right, gentlemen, thanks very much for joining in. So that's the view coming in on the banking space.